So thank you, everybody who came in here to join us. I appreciate it. I'm Rachael Rothman. I'm not the moderator today, but I'm going to introduce Dan Lesser, who is the president and co-founder and probably CEO of L&W, and he's a legend in the hospitality industry. He's going to give a few opening remarks about his perspective on where we're going for the future, and then the three of us are going to debate it. So it's great. We're pleased you're here. The only other thing I'd like to say is we want to make sure that this is as interactive as possible, and we're here to answer your questions. This is to add value to you all. So any questions you have, please just raise your hand. We can interrupt what we're doing, and we can take your question and answer it. Are you guys okay with that? Okay. Thank you so much.
I'm really not sure why I'm moderating. I think Rachael ought to be moderating. And I will tell you, I've moderated many panels in my career. I've never been introduced by a panelist as the moderator, so thank you. It's a first for everything in life. Yes,
you've earned it.
I'm Dan Lesser. She already introduced me, and she introduced herself. Why don't we just go down the line, and we have a surprise guest here who will, why don't we start with you, Isaac?
Yes, I was recruited by Rachael just a few minutes ago, so I'm Isaac Laza with STR. I head up the analytics group there and do all the forecasting methodology, so I'm just here now.
And it's great because he has no idea what questions are coming down the pike. So anybody who doesn't know an answer, Isaac is going to give the answer. Zach.
Yeah, I'm Zach Demuth. I'm with JLL. I lead our global hotels research practice.
All right. So we're going to be talking about, obviously, luxury, hospitality. I would like to just take a moment and sort of provide a backdrop of sort of the lodging industry in general, which includes luxury. I'm going to go through three slides really quickly and just kind of get to the questions because you want to hear from them, not from me. But just at a very high level, and this is in the United States, this is not necessarily globally, and I know this conversation will be about global, but lodging fundamentals remain quite healthy here in the United States. The revenue per available room, or RevPAR, is rising very modestly. The rise is attributable exclusively to increasing room rates, again, very modest ADR. Americans continue to travel abroad, which is great for United States citizens, but it's not great for, obviously, domestic travel. And foreign travel has been slow to come back post-COVID. It is coming back, but at a slow rate, and I'm sure we're going to get into this. Operational costs are definitely a challenge for the sector, so you do have revenues that are increasing, again, modestly, but in many situations, insurance, labor, property taxes are going up much faster than inflation. So there's definitely pressure on the bottom line. Permanent hotel closures are happening, particularly on both coasts. It really was in earnest occurring during COVID. It's still happening. What I find very interesting is that within the commercial real estate sector, all other asset classes, whether it be industrial, retail, what have you, they always to office, they talk about net new supply. For some reason in the lodging sector, we only talk about new supply. And it's just one of my pet peeves. I think people ought to think about that. Transaction volume has definitely slowed. I know we're going to get into that. But there are many reasons why we expect activity to catalyze and be fairly robust in next year and in several years thereafter. There are billions of dollars that are on the sidelines, a lot of which was raised during COVID, that's looking for a home. At this point, generally speaking, hotels can be acquired below replacement costs. So feasibility development is not as robust as it was in prior up markets, if you will. And we're seeing most money that's coming into the sector going to existing assets versus new development. It's interesting. Rachael called me a legend. I'm only 19 years old. I don't know how that happened, but and I've been doing this for 40 years. The math works, believe me. I've been doing this a long time, and I don't recall ever a period of time where hotels were considered a preferred commercial real estate asset class. It was always sort of the fifth, stepchild within office, retail, industrial, what have you. And today, it's perceived as a highly desirable asset class, and I know we're going to talk about several reasons why that's occurred, but it's, again, a phenomenon that I've only seen recently after 40 years in this business. A lot of high-quality assets have been trading for some pretty big numbers. I'm sure we're going to talk about that. There's a lot of hotel debt that's coming due. And it's interesting, another comment I would just make is that I don't recall ever there being a time where there's a lot of money looking for a home. At the same time, there's a lot of debt that's coming due that's going to have challenges vis-a-vis refinancing, and we're going to have many sales that are forced because of that. So those two phenomenon happening together is somewhat unique. And we're going to see, and we already have seen, some quote-unquote distressed induced sales. But there's so much money out there that anything that has a good story to be told eventually gets bid up. So we're seeing, and we will see, distressed induced transactions that don't necessarily reflect distressed pricing. The last thing I'll say is the outlook remains solid. There is uncertainty out there. There's no question about that. We're all aware of that. Thank God the election's finally over. But the near term looks pretty good. So with that, Rachel, do you want to take over? No, okay. All right, Rachel, why don't we start with you? I gave my outlook. What's your outlook for the sector overall, and dig into luxury specifically for the balance of this year and then into next year?
I mean, I hate to be a downer for anyone, but you know, if you're talking about low single-digit top-line growth and cost increases that are well above that, we would be concerned about not just margins, but gross operating profit dollars and what that means for the transaction market and what that means for the guest experience. Just in general, it's hard to reinvest in the assets because cash flows have been depressed, and we see operators just skimping on the services that they're operating with in an effort to shore up margins and profits. So I guess we would say we're a little bit less optimistic than you are. If you were talking about sort of true boutique luxury, maybe something over, I don't know how Isaac would define it, but over $750 or over $1,000, then I would say each asset is more unique and you'd have to look at the specific of each individual property. But just sort of your commercial luxury overall does not appear to be doing that great, particularly because leisure's been suffering.
Yeah, I don't disagree with that. I think, again, looking at all the costs that have been creeping up, continue to creep up, and then ADRs have been somewhat stagnant, actually going backwards in the luxury sector, right? Occupancy has been a positive. God, I hope I remember all this correctly since I didn't prepare. But again, it's there are some assets out there, and there are some where we just heard, there are more $1,000 hotels than ever before in the U.S., and even when you adjust for inflation. So if I remember correctly, worldwide, there's 419 hotels now with the October year-to-date ADR of over $1,000, compared to 2019 when there was only about 100, 120, 125, something like that. And then when you adjust for inflation, it drops from 419 to 300. So again, there are some really high dollar properties, but there are also going to be seeing some squeeze as well, because you can, I mean, how many times can you go to those properties? I worry about that, you know, that there'll be some fatigue, leisure fatigue, where those hotels will also hurt.
Also, aren't occupancies at properties like that in the 50s and 60s?
Correct, yeah.
Just
Jack, you want to weigh in on this?
Yeah, I mean, it's hard to argue with either of you, given that this is definitely your space. But I would agree. I think, you know, RevPAR this year broadly, you know, from a global perspective, we continue to see growth, but it's not really in the U.S. To Dan's point, you know, more Americans are traveling overseas than foreigners are coming here to the U.S. We see really strong growth in Europe, right? Most cities in Europe, Paris, London, Rome, particularly in the luxury segment, are having historic years, right? Obviously, the Olympics happened, so that's part of it. But even if you remove, you know, the month or so of the Olympic timeframe, you know, many markets in the luxury segment are seeing RevPARs of 40+% higher than 2019, driven predominantly by average rate. It's really hard to see that continuing. I mean, at some point, right, things have to revert to the mean, right? To your point about fatigue, you know, we know the dollar's been exceptionally strong for the last 2 years. That's obviously not going to continue forever. Obviously, Americans are, you know, hit with higher inflation. We talk about interest rates in the commercial sense, but interest rates impact the consumer, right? Consumer borrowing. So I think all of that will lead to some contraction. I think on the flip side, when we look at it on a global perspective, we're really excited about what's happening in Asia. I mean, Asia's, you know, been the one I'll call APAC, but specifically, broader Asia, really the one region that hasn't recovered relative to 19, broadly speaking. And we're seeing a lot of really positive tailwinds there. Chinese travel is starting to really accelerate. What's happening in India is really exciting now, they're the most populous country in the world. So I think that should offset some of the softness elsewhere. But we're talking about the U.S. I totally agree with both of you. There's clearly going to be a slowdown. These rates can't continue forever. And then, of course, what's happening on a cost perspective.
Is it possible to get the original slide back up, if possible? Thank you. It's interesting. Everything in life is relative. I remember in the early 1990s when hotels were literally losing money from operations pre-debt service. So, compared to that, things are soft today. There's no question about it, but they're a hell of a lot better than they were during the early 90s. Let's talk about global traveler preferences. How have they shifted in the post-COVID world, and specifically for luxury? Zach?
I'll start, but you guys please chime in. I think, what we saw pre-COVID is people want experiences when they travel. They want authentic experiences, and that's really accelerated post-COVID. You saw kind of in the immediate aftermath of COVID when the world sort of reopened, there was this concept of revenge travel, which may be continuing in some parts of the world. People wanted to get away, but they wanted to get away authentically. And clearly luxury is best suited to cater to that, right? Luxury hotels, whether it's urban or resort, have the means to offer unique, authentic experiences. And so I think that's really what we see more and more. That's partly why average rates have been so high. People are willing to pay for those experiences. And again, luxury is really best suited. I think what's interesting again now, or call it almost 5 years, kind of post-COVID, however you want to define it, how much are people willing to pay, right? Experiential travel is great, but how much of that really exists in the world? But it's definitely something we continue to see, and luxury hotels can continue to push the limits.
Yeah, and there'll be a panel tomorrow that I'm on, actually, on events and how that's working. So that at least I'm prepared for on that one. But I think the experiential piece of that and the event part of that is still the big driver. And again, when you look at like what Taylor Swift did and how it impacted hotels overall, not only luxury, it was all hotels. But there was also an interesting piece on that when you looked at it. Her concerts tended to also be on a Sunday, right? It was a Friday, Saturday, and Sunday. And so when you looked at the percentage change, because Sundays are so low, you also had some not apples to apple comparisons. But if you look at the absolute ADRs, which we also looked at, then you would see that those events did, regardless of the day, drive ADRs 100 plus higher than what a normal weekend would have been. So it depended on the market. Some were much higher, some were much lower. So, I think events are very important. I think that's the key driver. Last week, 2 weeks ago, you had F1 here. I met with MGM while I was here. I was here 2 weeks ago. And I'm spending all my time in Las Vegas. I have a gambling problem, I think. So, but it was interesting talking to them and just understanding how they were marketing the F1. In Bellagio, for any of you those saw the Fountain Club. So I got to experience the Fountain Club before it actually was opened. It's the most amazing thing I've ever seen. But marketing for very high net worth or high gamblers, so I guess they're high net worth people. And then one building was for you and I, but you and I had to pay $12,500 to be in that club. And that's crazy. That's just money that most of us don't have. And so I think, again, it's just a very select individual group, especially for here, Vegas, this is also Vegas, that they're marketing to.
Can I ask a question of you gentlemen, which is just sort of to follow on? One of the big themes that we're seeing in development overall is, of course, luxury branded residential and then luxury yachts, right? The Ritz-Carlton, these types of very high-end cruises, growth in Seabourn, Silver Seas, et cetera. And then what I might consider luxury home sharing, August, Picasso, et cetera. It used to be that, that exceptionally high-priced lodging product didn't really have a ton of competition. And if I think about where the industry is going to be 5 years from now, how much demand is there really for these, $1,000 a night rooms, and how much are these ancillary lodging services going to cannibalize that? Because they didn't exist before.
I think, and I know we'll talk about development shortly, but the reality is it's hard enough to develop a new hotel today. It's even harder to develop luxury. Most luxury products can only pencil if there's some sort of an ancillary component. Rachel, obviously you mentioned branded residences. I think at last check globally, something like 80% of proposed luxury projects, either in construction or planning, had a branded residential component. You're also seeing the brands now have standalone branded residential, right? St. Regis, Ritz-Carlton, Four Seasons, et cetera. But I think it's a really good point, right? I mean, if you think about the concept of branded residential, the reality is whomever buys those homes, they're not living there full time. It's second, third, fourth, fifth home. How many second, third, fourth, fifth homes can you have in different places? Now, there's obviously the access that you get with that, whether it's to specific discounts or the brand, but does that customer really care? I think it's, from our perspective, we see the demand there today. It's hard to envision that level of demand in 10, 15 years. But then again, global wealth is rising. I mean, over the last 4 years, there's more high net worth individuals than ever before. Again, keep mentioning India, but India is expected, there's expected to be more wealth coming out of India than any other country globally over the next 10 years. Parts of Africa, of course, the Middle East, the US, Europe, right? So on the one hand, it's hard to envision it. On the other hand, there's just so much wealth and there seems to be demand for it.
Okay, moving on. We're in the thick of budget season right now. How do you see the next 18 to 24 months playing out from a margin perspective? I know, Rachel, you touched briefly upon it, but maybe we can just expand a little bit more.
Down.
And and it could be more down, if that's a bad way of putting it. But it really depends on what happens on the cost side, right? We don't know if the tariffs do come to be. That will actually raise prices, at least in my mind. That's how it should work. And then the other part is if immigration is really slowed, that's also going to affect the labor side. So you have potentially high rising food costs and rising labor costs. So yeah, it could, but it just depends. Like right now, we just don't know. We don't know what will actually be enacted. We just don't know. But it does seem there's a possibility, maybe not a probability, but a possibility.
What about on the revenue side?
On the I think it would also affect revenues, right? Except high net worth individuals won't be impacted as most, but the casual traveler, definitely the casual luxury traveler, I think could be impacted.
So, as RevPAR slows, how are other revenue streams such as food and beverage, wellness, and the like, how are those performing?
I mean, unfortunately, our research suggests, and I don't know how you guys feel about it, but we've seen outperformance of non-CBD locations because there's a strong disintermediation from things like Uber, for example. It used to be that people wanted to be walking distance to the convention center. Now people are willing to be a 5 or an 8-minute Uber ride away if the rate is half as much. And so we see that happening, shifting the balance away from the sort of core city center. Another thing that's happening is that we see the food and beverage amenities needing to earn their right to exist, because it used to be that somebody would go downstairs and eat the $85 steak dinner on the corporate dime just because they had to. Now they can Uber Eat something to their room for $50. And so we're actually seeing declines in food and beverage sales. And the same thing is happening with spa revenues. Maybe offsetting that is some sort of day use passes for the actual owner operator of the property, but we would encourage the brands to distribute those day use passes to their most loyal members directly. We're not exactly sure why that's being disintermediated by third parties in the same way that OTAs did with reservations in the past.
I completely agree. So,
Anything you want to add? No. Okay. Let's talk about the. Go ahead.
Hear a little bit more about what you're talking about with day passes and things like that. Whenever I was living in Dubai as well as South Africa, we utilized our Ritz-Carlton. I was in a Ritz-Carlton every single week, spending hundreds of dollars. So was all of my friends, all of my coworkers. And since being back, I'm just not seeing that happening, and I don't understand why it's not pushed more. Like, what are the economics of that? Why is that able to happen abroad less often than it's happening here?
I mean, it does happen here. It just happens through third-party distribution. And my question for the brand would be, if you have 216 million members, why would you not push those opportunities to your most loyal members as a way to have them come? I mean, and it's not just the pool, right? Like, it's co-working, your lobby's dead. Why would you not want somebody sitting there all day eating a sandwich and fries and coffee, which have very high margin? Like, why would you not want to increase capacity utilization? Why is your brand not just another distribution tool? Why would you hand that to somebody else?
Trying to think of how to phrase it, but isn't it possible it might have, in South Africa, it was the only option or just a limited option, while in the States you have so many options versus a hotel? So why would you go to a hotel when you can go to your standalone spa or whatever near your club, and that has that service? So I think that's part of it. And I think in the States, we were just talking about this outside, that luxury hotels in the States kind of became homogenized, and they lost their way in the past. So if you looked at 2005, we made this date up, we don't know if this is right yet, but in 2005 there was a distinction between luxury hotels and everything else. And then since then, and don't quote that date, but sometime around you started seeing more homogenization. It was a luxury hotel, but it wasn't that much different than an upper upscale or even an upscale. And now what we're thinking is different, is that we are seeing with more of these very high-end hotels, that separation, something that's very unique. So that's what I was trying to find that word, that here in the States, they're not that unique, while in South Africa, it was more unique. And maybe that's the difference, and that's why people go there. It's the experiential, it's very different. We don't have that. Here it was just, it's just another hotel. And maybe, again, that's just a hypothesis that we started thinking about 10 minutes ago.
I think the other thing, too, goes back to Rachel's point around how luxury hotels have bolted on these other concepts. One of those is private member clubs. And on the one hand, it sounds great on paper, right? Like, you can underwrite free cash flow. Aman's, as an example, has been exceptionally successful. And I think they've done it better probably than anyone, but a lot of brands have tried to copycat that, particularly here in the US, basically creating, in their minds, this exclusive experience, and truly exclusive, right? As a non-hotel guest or non-paying member, I can't even go into the hotel. I would argue if you can do it, you can be very successful at it, like Aman. The reality is Aman is probably one of a kind, or maybe one of two or three. And to your point, you're really limiting yourself, right? You've created an environment where it's exclusive. Yes, you're delivering probably an exceptional experience, but you've cut yourself off from, to your point, a lot of locals who may have the propensity to spend, and to Rachel's point, loyalty members who would otherwise jump at the action. So I think it's a balance, right? Luxury wants to be exclusive, wants to create experiences, but become too exclusive, you miss the opportunity.
Let's talk a little bit about the luxury hotel sale transaction market. What's happening in that space, and maybe, Zach, you can talk about some notable trades that have occurred thus far this year. Actually, it was just announced that Blackstone bought in Athens, the Grand Hyatt.
The Grand Hyatt, yeah.
So maybe you could talk about it in the States and then internationally.
Yeah, I mean, I think you led it off right, Dan, right? It's no surprise, no secret that transaction volume, both in hotels and broader commercial real estate, has been challenged for the last two-ish years, 2+ years, depending on how you want to count it. I think this year through October, globally, there's about $46 billion in hotel asset liquidity. Sounds like a lot, but that's down like 35% relative to pre-COVID levels, and even down versus where we were in 2021 and 2022. I think what's interesting is the one area, or I guess there's actually two areas that we're seeing bright spots. First is on the lower tiers, right? Select service, extended stay. I know that's not what we're here to talk about, but the reality is those hotels have generally performed up until recently exceptionally well, higher margins, and they're just lower check sizes, right? So it's a much larger buyer pool. I think what's interesting is we've seen similar demand from an investor perspective for luxury. Of that roughly $46 billion, nearly 20% is luxury transactions, which is a lot. Historically, maybe 10, 12% on average is of global hotel sales are driven by luxury. Again, numbers are down, so if you take it on a relative basis. And to your point, we've seen a tremendous amount of demand for not just luxury, but like high priced, in the price in the sense of average price per key or values. I I think year to date, there's been something like $25 million plus per key transactions, which is on par, if not more, than we've ever seen before. You had the Turtle Bay Resort, which is now a Ritz-Carlton, acquired for over $1 million a key earlier this year. The Biltmore, which is LXR hotel, also over $1 million a key. Recently has had the W South Beach, approaching $1 million a key, give or take. We've seen six Senses trades across Europe, Middle East, and Asia. Again, all of those $2 million plus a key. Aman's, again, so the list goes on. And part of that, I think, is just strong performance. Part of that is just this building of wealth, again, both from a traveler perspective and an investor perspective. And then part of it is we've finally started to see more institutional players buying into luxury, obviously Blackstones of the world, Henderson Park, who bought the Biltmore Hotel. We've seen some public REITs here in the US, big private equity groups. And that's partly, again, part of the performance, but there's also been some strong yields. So it's interesting, right? I mean, transactions are broadly down, but there's a lot of demand for luxury hotels. And it remains to be seen how that changes, right? As performance likely dips, will that create, in some sense, more demand? There's clearly capital on the sidelines. But yeah, I think luxury's been a real bright spot from a transactions perspective.
Your point about the $1 million per room sales is spot on. It wasn't that long ago that when a transaction like that occurred, it was like big news. Today it's news. It's not big news. It's much more commonplace. And I think this year we had a single asset trade for over $1 billion, the Hyatt Regency Orlando.
Yeah, Hyatt sold off balance sheet. Right. You're totally right. I think we were joking in the office the other day. It's like now $1 million isn't big news. 2 million maybe, but now there's actually 3 million. I think we've had 3 million plus per key transactions, which is unheard of. I mean, you think about the economics on that. How are you really making money on that transaction? And if you are, what's the underlying performance look like? So I think it's pretty impressive.
Yeah. Well, I mean, the fact is, without naming names, the hotel industry is very well known for attracting lots of ego capital. That the first goal is I want to own that place. You want to make money? Yeah, that too. But I want to own that place. Isaac, Rachel, anything you want to add about transactions?
No, not particularly.
Okay. The wave of loan maturities that I alluded to early on, is that going to be affecting the upper end of the market?
I think it's tough. I mean, if GOPs are down, if we wind up being right about profits being pressured, I think there will be pressure. Of course, people need to refinance, but I think they also don't necessarily want to sell their asset for 25% less than they think it's worth. And so I think part of that has been clogging up the market, so to speak, or just slowing everything down. I think it's hard. I'm not expecting a big wave of transactions, but I'm definitely not an expert in that field.
Same here, but we've been expecting a wave since the end of the pandemic, and it hasn't happened, so I'll say just more of the same.
Yeah, I think, Dan, you sort of referenced this, like we call it like distress, but with a lowercase d, right? It's not like actually distress, and particularly in the luxury space, it's definitely not actually distress, but there is some level of stress, right? I mean, clearly if GOP goes down, debt service, interest rates are up or stable, so that means your debt service payment is up. Like the math just doesn't work. I think the one thing to keep in mind in the luxury space, you mentioned ego buyers, right? There's a lot, it's becoming more commonplace, but generally there's a lot less leverage, right? A lot less debt, right? You have a lot of all cash buyers in luxury, a lot of foreign buyers. And so debt service doesn't exist to the frequency. Again, I mean, that's changing. But it's hard to envision, to Isaac's point, like we've been talking about this like wave of maturities, this distress wall. If it hasn't happened yet, I mean, with a couple of notable exceptions, San Francisco, others, but it's hard to envision it happening now.
It's interesting, as a little side point, we talked briefly about Blackstone, and when you look at Blackstone over the past 20, 25 years investing in the hotel sector, they're always buying and they're always selling. They don't necessarily, time markets as opposed to timing individual transactions. The reason I bring this up is I just read the other day that Blackstone, I don't know, when I hear Blackstone, I think, okay, they're almost perfect, right? Nobody's perfect. They're almost perfect. But they're about to lose control of a portfolio of club quarters hotels, which, I don't know, I just find that interesting that even the smartest folks out there can mess up as well. Let's talk about new development of luxury hotels. I know we touched a little bit on it. Is there debt out there for that? Is there equity out there for that? Where is it occurring if it is occurring?
They're very small projects. I mean, I think, again, luxury can be defined as many things. If we're talking about an STR chain scale, a traditional, I don't know, St. Regis Monarch Beach or a JW somewhere, that's very different than a small Six Senses that might be trying to open in rural Pennsylvania, which, scratch my head, or upstate New York or whatever. So I would say that they're probably smaller deals, maybe tending more towards the vanity projects.
Yeah, I think you're right. And they're also a lot more overseas. We're seeing them in Asia. I mean, that's where we're seeing that big development. And up top of my head, I was trying to remember all the pipeline stuff, and I just, sorry.
And a lot of branded residential, right?
Correct.
Yeah, Asia, the Middle East, right? I mean, some of the mega projects, obviously we know about what happened in Dubai over the last decade. Now we're starting to see it in Riyadh, right? I mean, but you take the Middle East out of it, which I think, to Rachel's point, while maybe they're not all boutique, it's an exception because of the amount of wealth there. The reality is that, as we all know, new development's exceptionally slow. It's why the brands have had to turn to other means to try to grow their net units under management. The luxury projects that are getting done are either the ones that have a branded residential component, maybe heavily boutique, or all cash, because development financing today is really expensive, and projects take longer, right? And supply chain disruptions, as we know it, have been somewhat moderated, but maybe they return, and so that creates more challenges if you're a true institutional investor.
And the strength of the dollar and now this whole tariff debate, I mean, I just think it's going to be challenging. I think it will be more conversions.
We've seen quite a bit of M&A activity in the lodging sector with brand families and management companies. Is that affecting the luxury part of the space at all?
I mean, depends, again, how you define luxury. I mean, Hyatt bought Standard, which, again, depending on your definition, I don't actually know if is Standard STR luxury.
Yeah, I don't know if
I don't
Standard
know.
is. Yeah, I have to check on that one.
Maybe. So let's just assume it's close-ish. But we haven't seen it to the same degree, right? I think, take a step back, the brands, when we talk about the brands, we're talking about the C Corps, Marriott, Hilton, Hyatt, et cetera. The way they derive value is either by growing same-store revenue, right? So same revenue growing in their existing portfolio, or by adding new hotels. And historically, adding new hotels comes through organic development, but as we just discussed, there isn't much of that. You can get some with conversions, as Rachel mentioned. Again, that's a slow growth play, so the biggest way to grow is by acquiring other brands, so Hyatt and Standard, Hilton and Graduate. In the budget space, OIO bought Motel 6 from Blackstone. I think we've seen on the luxury side is not necessarily brand acquisition, but private equity investment. We saw earlier this year, late last year, MSD invested, well over $1 billion into Auberge, which is, a collection of luxury hotels. Again, not an acquisition, but a way to really fuel significant growth, absent kind of affiliation with a major brand family. Luxor Capital did similar with Montage late last year. So I think would be interesting. We've seen some interest from the major brand family, some of the independent luxury, whether or not they're willing to pull the trigger, do they have the balance sheet to do it? But there's a real argument to be made that there could be some real opportunity.
And even on the independent side, looking at conversions, when you look at, I was actually looking out on the plane today, we haven't seen that many conversions either from luxury independents to branded independents, et cetera, because I was specifically looking at the branded side, and still very small. There is some, but it's not a heck of a lot.
Soft brands, right?
I'm looking at just conversions, that taking something from an independent to a St. Regis or something. You're just not seeing that much. You are seeing the soft brand stuff, but even on that luxury class side, that chain scale, the amount of conversions over the last 5 years is very little. It's not a lot.
What are we most excited about for 2025, and what do you see for the near-term outlook? That's the optimistic side of me. I don't want to hear the negative stuff.
Coach Rachel.
I would say sitting in, my role is global. I think there's a lot of optimism for other parts of the world. On the one hand, I think we should stop comparing against 2019, and so I'm somewhat excited about.
No. No.
Oh yes, well,
about that later.
we can argue that. But assuming we use 2019 as the benchmark, the reality is that a lot of regions haven't recovered. Most of those in Asia, and I think there's a lot of optimism there. So I'm pretty excited about that. I also think it's going to be really interesting to see what happens from a high net worth perspective. I mean, this is not a negative comment, but at some point ADRs have to abate, and how do they offset that, right? Is it ancillary revenue? Is it additional experiences? To me, that's, again, you could look at it as a negative, but to me, that's an exciting opportunity for hotels to reinvent themselves.
So I think what I'm excited about, because you really made me think there, Zach, I'm excited about even those, there's a lot more uncertainty. There's optimism and then there's uncertainty, because we're uncertain of what will actually be enacted by the administration. That's the piece we just don't know. But whatever happens, if it is negative, innovation actually comes out of that period. People will figure out how to make money. People will figure out how to keep our hotels going. It will happen. And so maybe we get out of the complacency that we've kind of been in, and that's why I don't want to get rid of 2019 as a benchmark, because it's like if you don't know where the goal is, and the goal is we were doing really well in 2019, and you say, we don't need that anymore, then you get complacent. But the environment we're getting into may be something that says, hey, sparks innovation, say, hey, we got to figure this out. And we figured it out. Even interest rates have been high. There is still development happening. People are still traveling, so we'll figure it out. That's the exciting part.
And there's some markets overseas, right? Spain, Portugal, Cabo, San Miguel de Allende. Like there are markets that are doing very well.
Japan.
Greece, yeah. But just I think the U.S. is somewhat challenging currently, particularly with the strong dollar and Americans' propensity to go overseas. That bodes well for other markets.
I get a lot of pushback, but I candidly believe that now is the time to be investing in San Francisco. A lot of people push back on that. EOS Hospitality bought the Hotel Zoe, $350 a key, all cash. I think a couple of years from now, that's going to look like a brilliant transaction, and there are more of that coming. And you mentioned uncertainty. It's kind of interesting when you look back over life, right? Uncertainty is like
every day.
Certain, right? It's exactly. It's always going to be something. Right. I'm sorry, you were going to.
Oh, I totally agree with San Francisco. Actually, I think it was yesterday, the day before. I don't know who the buyer is yet. They haven't disclosed. Bought the note on the Four Seasons San Francisco, and that's going to price at sub $300 a key. And I think, right, if you could imagine New York City and you could have purchased something at sub $300 a key. I mean, think about the opportunity. If you can weather the next 2 years, it's just a substantial upside.
If you think about New York City, right? COVID was 5 years ago, 4.5 years ago. New York City was done. It was written off, finished, never coming back. And I remember when MCR bought the Sheraton on 7th Avenue, monster hotel, $250,000 a key. People thought they were nuts. In my mind, there's no downside at that basis.
I would also say, though, just to go back to where you started and just to play devil's advocate for a moment, you talked about in the early 90s hotels not making any money. So I grew up in New York City in the 70s and 80s, and I can tell you firsthand that from the late 60s to probably 93, no one wanted to be in New York City. And the idea that it was going to turn around quickly or be a place that people wanted to be, there are cities that can get sidelined not for 2 years or 3 years or 5 years. There are whole cities that get sidelined for a generation. So I think it's great to say buy on the dip, but I think we have to be cognizant that there can be risks to those strategies.
There's no doubt about that, and I agree 100% with what you said. I was born and raised in New York as well. I remember doing a feasibility study in the early 80s for the Marriott Marquis in Times Square. And that was like, what? I mean, Times Square was a cesspool back then, and now it's 1,000% location.
It took 20 years.
It did, yeah. Isaac, did you want to?
I was just saying, going back to our central theme here of luxury hotels and the optimistic part of us, Luxury hotels are really the best positioned, right? Again, the experiential factor is not to be forgotten. People do still want experiences. That's why everyone's Instagramming everything. And so they want something special, and luxury hotels are the ones that can actually deliver that specialness that no other hotels or other hotels can. So I think that's the optimistic going back, going, is 2025 going to be hard? Maybe, maybe not. But again, this is the best sector to be in because, again, you do have the demographics that stay at a luxury hotel are just different from the masses.
And it's, I think, to your point about investment, I would say luxury is the best place to invest too because of the tailwinds from a demand perspective, and they're irreplaceable. And we talked about developments not happening, or it's happening on a very limited basis. Discount to replacement, again, you don't necessarily buy on that, but it's real. And so you're looking at constrained or if not negative supply over the short to medium term. And yes, demand may fall, but again, just basic economics, unless demand falls, significantly below supply, which is hard to see, it's hard to see, luxury being a bad investment. Again, depending on your basis, but.
And the good news, it can't get as bad as it was in 2020. I mean, it can't.
And look how quickly we reward, in the luxury space at least, roared back, so.
Exactly.
Do you want to see if there's any questions from the audience?
I first was going to ask if anybody's Instagramming us here. Okay, do we have any questions? Yes. You said you both. There are four of us up here. Who are you talking about?
Anyone can answer. I'm interested in globally. But in the U.S., I feel like ADRs have gone up while consumer spend has kind of gone down.
I ordered a $25 drip coffee downstairs. By drip, like put the cup under and they pull the thing. I won't be going there again. So.
Yeah, because that missed up, that price value wasn't there. It wasn't an experience. It's just coffee, right?
It was not like in a science thing.
Yeah.
It was like you pull the lever. Yeah, what?
I think it goes.
Fell over. Can you pour it back into the dispenser?
I think it goes back to the price value, right? It depends what you value and how much you'll pay for it, right? So I don't know if there's a real answer. Yes, on the margins, are ADRs pushing some people to do something different than F&B? Possibly, but I don't know how we'd ever quantify that. But it just, people see the value, because again, those experiential things, people are willing to pay for things that are above and out of the ordinary. And I still think that's going to occur. And again, there's different price points. Not everyone's going to pay $12,500, but someone might pay $100 when normally they would just pay $5 for their coffee at Starbucks. And so, but it just depends. It depends it's that price value thing. It's what we all learned in marketing back in the day.
But do you mean, are we trading up by pushing a higher rate? Are we getting a higher yielding customer? Or are we just taking the share of wallet up front on the rate? Is that what you're asking?
I didn't think about that.
Yeah. I think it's number two. I don't think we're getting a higher rated customer. I think we're taking the share of wallet in the highest margin segment of the business, which is the room. And that's why the people are Ubering their food, because they're not going to throw down $80 or $125. But that's just N equals one opinion.
No, I agree. I think there is a level, we talk about experiences, there's also food experiences. And I think we talk about reasons why people travel, maybe less so in the US, again, to Rachel's point, because of Uber, because of city concentration, you don't need to stay at the hotel that has the great food experience. But like, we just did a big study in San Sebastian, Spain, which has the highest concentration of Michelin star restaurants of any place in the world. And there's now a lot of those restaurants have relocated to hotels, and they see people going to the hotel just for the restaurant, which is sort of bizarre because you can eat there without staying at the hotel. But I think that, again, to Isaac's point, there's a very specific consumer segment we're referring to here. It's definitely not broad enough to support all the luxury hotels globally, or likely even in one destination, but it does exist. And so I agree with Rachel's sentiment on the 90% whole or 95% whole, but I think there is in the right segment and the right demographic, that, you know, small percentage of experiential travelers beyond the room.
It just goes back to creativity as well. I don't know if you saw that in the New York Times last week on Per Se and the French Laundry.
They got destroyed, though.
They got destroyed. But it is, to me, maybe it's the same. Nothing's changed. And there's fatigue there. It's like, if I'm going to pay that, I want to be wowed. If I'm only going to be wowed one time, that's not what people want anymore. They want to go back, but if it's the same thing, it's the same thing. And are you really going to pay that? And that's what the article kind of referred to. That was an amazing article. Sad for the group, but
Very sad, yeah.
And San Sebastian's relatively inexpensive. I mean, this goes back to like why Americans are going overseas. I'm actually going to San Sebastian for spring break. I booked your probably at the Maria Cristina, which is probably what you were looking at. You did not disclose anything. 5 days, 2 rooms, $2,000.
And I mean, that's a true
Rooms,
five-star
5 days.
hotel.
That is the most expensive property in San Sebastian. So it's just the price value is completely different.
I mean, you mentioned Taylor Swift, right? We saw more Americans go to Europe, pay for a plane ticket, pay for a hotel room, and buy a ticket than we did apples to apples basis, people staying here, right? Because of the price value.
And they got a few extra days to do some touring. Did we have any other questions? I guess not. Well,
Sorry, show of hands, how many of you guys are bullish on next year? Optimistic? Anyone?
Anyone?
Slightly? Who's not, or who has more tempered expectations for next year? All right, so most people are, all right. That's
Well,
helpful
that-
feedback, thank you.
and we saw that at the lodging conference. It was very optimistic.
so I'd like to, yes, we have a question.
Question in the back?
It was all rehearsed. It was all rehearsed, yeah.
You really caught me on the San Francisco market. Because clients there have watched us really struggle, but I believe when you say that it's going to be, back to the price point. I'm just curious how you think about old markets versus new markets, what that balance is.
By old, I assume you mean like the forever, like New York, relative. Would you consider Nashville a new market, or like how? I mean, I'm just trying to get a newer. Okay. I mean, and again, I don't know from what lens you're looking at, but from an investment perspective, again, there are definitely markets that go through years of challenges, but our belief is that the forever markets are forever for a reason. The New Yorks, the San Franciscos, Miami's, I'd say newer, but still there. Globally, Paris, London, Rome. I mean, that's where the institutional investors have always parked their money, and there's a lot of stability there, even though there may be some dips in stability. I think newer markets, again, depends how you define them. There has to be, to Isaac's point about broadly, there has to be what is the demand driver, right? I mean, Nashville, one of my earliest jobs, this was like, I would say 15-ish years ago, like we looked at like a study in Nashville, and like they had a plan about how they were going to drive, right? It was going to be, first started like social events, then music, then they expanded the convention center. I mean, but that was like a long plan. I think there are some markets that pop up as like exciting because something happens there, but then how do you repeat that, right? And so from an investment perspective, I think the forever markets are forever for that reason. It's hard to become a new market that's forever. I mean, we have the value of looking in hindsight, but I think there has to be that infrastructure that builds the longevity.
Yeah, I think for like Nashville, as a part-time resident of Nashville now, it's the continuous reinvention of that market. It's the most amazing thing I've ever seen. And again, I get to live downtown, and you go, this is amazing. But it was very much planned. Everything is within a 10-minute walk. And so it's the perfect leisure destination for getaway because everything's right there. And they're continually rethinking that. And obviously it's gone from country music to everything. And so they just didn't stick with one thing. They broadened it.
I just think also San Francisco was a very convention-heavy business, and one thing that would concern me is that it's a very expensive market, And would my company prefer to send me to Dallas or Orlando, where I can take a $30 Uber and I can have a $50 gourmet meal and I can get in and get out with sunshine? Or do they want to send me to New York or San Francisco, where the Uber's $100 and the food is $100+ and the experience is not that great? I just think that since it is so convention dependent, it does give me a bit of pause, personally.
But again, it was very unique. It was convention driven because of the uniqueness, where you could take your attendees on a cable car to, I can't think of the top where the Intercontinental is. I can't think of it anymore. Nob Hill. God, I couldn't think of it. So I think that was the lure, and now it's gotten so much bad press and then of course the higher cost of everything in the city. But it could come back. It could come back. It's a city that has a unique charm.
Somebody also said to me, it was actually one of the hotel CEOs, I wonder what you guys think about this, but he said to me in the 90s to go to a Michelin star restaurant or a gourmet restaurant or an amazing concert or some live event, you had to be in Manhattan or you had to be in a San Francisco. Now you can find 3 Michelin star restaurants in a random county in Virginia. You can go and see concerts in Vegas, in Nashville. Almost anywhere has unique and high-end experiences, and I just think that raises the level of competition overall for the sort of U.S. gateway cities.
I mean, I think to your point, it comes down to diversification of demand, right? I mean, if you're heavily reliant on conventions and convention business isn't there for one reason or another, it's hard to be successful. I think Nashville is a great example of reinventing itself and being massively diversified. You do have conventions, they're very good at it. Obviously, have leisure travel, some corporate travel, everything else. I will say, and I'm also a firm believer in San Francisco's potential in the medium to long term, it's also about access. I mean, Nashville, has done an amazing job about becoming more accessible, but San Francisco is not just accessible from most of the US, it's exceptionally accessible from Asia. And while the Asian traveler has been very slow to return for a number of reasons, and again, we'll see if we thought it was going to get better, and we don't know if it will because of some possible policy changes, but at some point it will. And I mean, that's the easy, sure, Los Angeles is there too, but I mean, I think, San Francisco historically has 25% of demand to some capacity arriving from incoming Asia, right? And I think that's not going to change. Like, the geography isn't changing, and so that's again, forever markets. New York, you'll get the same from Europe and other parts of the world. So I think that's also really important.
I guess we could keep going on, but our time is up, and I'd like to thank the panelists, in particular Isaac, who literally got nabbed 2 minutes before, and he did an amazing job. So thank you very much.